Okay, hello everyone. So excited to be here with you today. Tons of value in this presentation, and I'm thrilled to share more about our mortgage marketplace. I see a lot of familiar names on the call, so thank you so much for being here. But I also see there's a good number of new folks tuning in as well, which is fantastic. To give a little bit of a roadmap as to what you can expect from this presentation, this webinar is geared towards helping both our existing and prospective mortgage, trust deed, and note investors better understand the mechanics of our lending program and to demonstrate how best to take advantage of the resources we offer on our mortgage marketplace. Whether you've been lending with us for a decade or this is your first time seeking us out, this webinar is jam-packed with loads of great content for all experience levels. Also, throughout the webinar, feel free to leave your comments in the chat and we will follow up with you to help supply answers later on. So first, to briefly introduce myself, my name is Aaron Byrne. I'm one of the investment analysts here at Marshall Reddick Real Estate. I started with the company back in 2019, and I've truly enjoyed being a part of so many of our clients' journey to financial independence over the past few years. As I'll be diving into the mortgage marketplace in this webinar, I now want to take a break from my slides and navigate to our website where our mortgage marketplace is located. You can find us at marshallreddick.com. So switching gears to the lending program, Marshall Reddick has been in real estate as a company since 1979. We have a rich history, and it's thanks to an amazing team of professionals and wonderful clients like yourself who have helped us stay going strong for over 40 years. As far as the lending side of the business, we have been in the private lending space for more than a decade. It started out with us lending to our longtime referral agents who were buying properties on the courthouse steps, but we eventually opened up these lending opportunities to our longtime Marshall Reddick investor clients, and it's only gotten bigger and better from there. Today, we primarily work with two types of investors, borrowers and lenders. To explain further for those who may not be familiar, our borrowers are investors searching for financing solutions for their real estate activities, whether flipping a home, building a new one, or buying and holding for the long term. Borrowers seek out Marshall Reddick to help them accomplish their goals in real estate. As for the other investor type, our lenders are interested in the passive income offered by secured debt notes. After we take the loan application from our borrowers and evaluate the deal to determine if it fits within our proprietary guidelines, we then offer those approved loans as investment opportunities to our direct lenders like yourselves, or to our mortgage fund, which in essence is our largest direct lender. Now that I've clarified the two investor types, I think it's important for our current or potential note investors to be aware that we publish our loan programs publicly on our website. This is not only so our borrowers can review what their options are, but also so our note investors can get a feel for what opportunities they might find to invest. For those of you who are interested, you can find these programs by navigating to our website, hovering over this borrow section here, and clicking on the loan programs option. I'm going to go ahead and open a new tab here. And I'm not going to spend time going over these today, but I just wanted to point them out for your further exploration after we sign off in this presentation. Now, as mentioned, this webinar is geared specifically towards our lender clients who are interested in secured debt note investments. Now, in our lending program, we have two options for our lenders clients to choose from: direct lending or pooled investing via the Marshall Reddick Mortgage Fund. Now, as with anything, there are pros and cons to either option, but our number one focus in each is that we service the needs of all of our clients. Each route offers value depending on the type of investor. Nevertheless, regardless of which option you decide to utilize in your portfolio, the underlying investment is the same. It's low risk, solid LTV, first lien debt, fully underwritten by Marshall Reddick investment analysts like me. Now, I'm not going to speak to the specifics of the direct lending or pooled investment options today, but instead really focus mainly on the mortgage marketplace. After a few years of operating in the private lending space, we began receiving much more demand for our lending programs, which led us to create the mortgage marketplace. To give a brief description of what the marketplace is, picture it as sort of a MLS or multiple listing service for those who are unaware of the term. And the MLS in real estate is where all the publicly available homes are listed for sale, and realtors go there when searching for homes for their clients. Our marketplace acts in the same way, but for mortgages, trust deeds, and notes. Through this platform, lenders can access their loan portfolio, check for updates on their current investments, shop new lending opportunities in real time, and conduct research about our past history, default rate, as well as review which markets where we lend. I'll touch more on how you can view our historical data later in the presentation, but a key takeaway for now is that this platform we created offers tremendous upside for our investors by providing invaluable resources to help them make educated investment decisions. Now, before moving on to show you how to navigate the software, I want to briefly explain where the opportunities published on our marketplace come from. Now, Marshall Reddick serves not only as the administrator of the marketplace, but also as the broker of lending opportunities. We work with hundreds of reoccurring borrowers in markets across the country who are investing in real estate and use us to finance their activities. Now, please note, just because they come with us with a lending opportunity does not mean that the deal ends up as available on the mortgage marketplace. Before getting to that point in the process, Marshall Reddick vets each deal and arrives at a loan structure to protect the lender. All this is done by, again, an investment analyst, such as myself, before the note makes it to available on the website. Therefore, every loan you see come available for investment is Marshall Reddick approved. Our attention to detail and commitment to being conservative is what we believe has helped us and our clients be successful in our investments, and we intend to keep it that way. Now that we all have a better understanding of the general points, I now want to take us to the marketplace and demonstrate how to utilize some of the available tools we offer to you as investors. To get to the marketplace, you can find it from our home screen. Instead of going to the borrow option like we did before, you now want to hover over the invest tab and select mortgages from the available options. This is where our direct lenders go when they are looking to shop for new investment opportunities, or where prospective investors can go to conduct further due diligence before getting involved. Right now, we are in list view. And as you can see, there are nearly 3,000 results and over 200 pages available for review. Now, likely not all this will be relevant to you. So I'd like to take some time to demonstrate how you can further refine the listings that appear to better suit your needs. To do that, you can use the More Filters button. The More Filters button is found right here on this black ribbon at the top of your screen. We have a tremendous range of search filters to help you. Basically, run any report you are curious to run. As it would likely take much longer than we have scheduled for today to show you everything, I'm going to give you an overview of 3 search filters that I believe will be most helpful to you as an investor. But first, be advised, we do not offer fractionalized opportunities. If an opportunity on our marketplace shows a needed investment capital of, say, 100,000 or 190 in this example, the individual investor must personally supply the entire investment amount. It's one lender to one loan, not crowdfunding. If that's not of interest to you and your personal investment criteria, then maybe the mortgage fund model is better for you. In the fund model, subject to a $25,000 minimum, you have the flexibility to quickly invest the dollar amount that best fits your portfolio, unlike the marketplace, where you may need to be patient before you find the right opportunity. Now, as mentioned, I'm going to be highlighting 3 search filters that I believe will be useful to you as an investor on the marketplace. To do that, I'm going to bring back the PowerPoint and talk briefly about each search filter, plus the benefits of its use. So first, I want to talk about the loan status filter. The loan status is important as it's a quick way to switch between loans that need funding, loans that are active, and loans that are completed. I use this filter daily in my role as an investment analyst. It's incredibly versatile, which is why I wanted to highlight it here today. Loan purpose is the next filter. Loan purpose is important as it lets you quickly jump between loan types, from loans used to renovate properties to loans used for rental properties. This filter helps investors sort by loan type, as each purpose carries different yields, different terms and structures which suit investors differently. And finally, mortgage owner. The mortgage owner filter is important as it helps you quickly identify whether a loan was funded by a direct lender or by the mortgage fund. This helps you complete your due diligence by showing who funds what on the marketplace. So now that you kind of have an overview of why these three filters are useful, I want to navigate back to the mortgage marketplace on marshallreddick.com and show how you can use these search filters to run the reports for yourself. So first, we're going to begin with the loan status filter. To get there, you will navigate to the mortgage marketplace, where we are now, and then two more filters, which is this button here on the black ribbon at the top of your screen. From there, you will find the loan status filter in the top center of your screen. Now, as you can see, it is one of the largest filters, and for good reason, thanks to its versatility and its utility. Now, you'll notice there are 5 categories or buckets, if you will. Those are these right here on your screen. And under each bucket, there is a specific loan status, such as available, funding in process, approved for funding, etc. Now, I don't have time in this presentation to go over each of these loan statuses for you, but if you're interested, we do have an article that we wrote where you can read to learn more about each of the loan statuses. You can find that article right here under loan status definitions. I'm going to go ahead and open it briefly just to show you. Here is where you'll find all those definitions. And for example, in the approved for funding loan status, you'll see that all conditions haven't been satisfied, Marshall Reddick underwriter issues a clear to close, and the investor wires their funds to escrow.
Saturday or Friday?
Now, when using the loan status filter, it's important to start by hitting clear. That's this button up here in the top right on the black ribbon on your screen. This ensures that none of your other filters from a previous search interfere with your current report. In terms of functionality, the options available are to deselect all loan statuses, select all loan statuses, or you can deselect an individual status or select an individual status. By combining these options, you can tailor a specific report to meet your needs. Next, I want to look at the loan purpose filter. You can find it here on this second down far left of your screen. Now, as a reminder, this filter is important because investors are looking for different loans to better suit their particular needs. By utilizing the loan purpose filter, investors can more narrowly refine their search to display a relevant loan type. As you may have noticed, the features of this filter are very similar to the loan status filter. You can deselect all, select all, or deselect an individual loan purpose like hold, or select an individual loan purpose like hold. Now, a quick note, you can see on the top left of your screen the total loans that are currently found in this report. So if I was to click done, you'll see that over 2,900 results are shown. Another quick note is that you'll notice that to the right of the individual loan purpose, there is a corresponding number. What that number means is that out of these 2,900 mortgages in your current report, 444 of them are hold loan purpose. Same with renovate, build, etc. And finally, these all correspond back to your loan status filter. You'll see that 6 of the 2,900 selected are unavailable, 5 are in funding in process, etc. So there's very much a layering of these filters on the mortgage marketplace. Now, finally, we'll move to the mortgage owner filter. You can find it at the bottom of the left-hand side of your screen. Now, hopefully the concepts of the marketplace are starting to become more familiar at this point. While there are no deselect or select all options here because they're just two owners, you can individually select or deselect Marshall Reddick Mortgage Fund or the individual investor. So for example, if I deselect the individual investor and click Done, here at the top right of my screen on the black ribbon, you'll see that nearly 500 results populate on my report. Further, I know these loans are related to the mortgage fund thanks to this blue MRMF tag here to the right of the loan status. Now again, the mortgage owner filter is useful to see who is funding what on the marketplace. While both the direct lender and the mortgage fund originate Marshall Reddick approved loans, this filter will help you narrow down the results further and see what types of loans the fund is choosing to invest, as opposed to your fellow direct lenders, and vice versa. Now, I recognize there are tons of ways to use these search filters to display different reports. And some of our lenders are not as familiar with all the ways you can layer the filters to produce thoroughly refined reports. It can be overwhelming. So to simplify, I decided to pick 5 reports that I frequently get asked about, and I want to take this opportunity to show you how to run those reports for yourself. To introduce those 5 reports, I'm going to go ahead and bring back the PowerPoint for a moment, introduce each of them one at a time. First, what loans are available now? This report is important as it helps investors locate and commit to new loan opportunities. If you've completed your due diligence and want to move forward with funding a loan, this is the report to run. Next, how many active loans does Marshall Reddick currently manage? Asking what loans are active is important as it allows our lenders to gain an understanding of the size of our current portfolio. You can use this to discover what markets we favor lending in, as well as how our current loans are performing in the market. Next, how do you structure your renovation loans? Now, understanding our loan structure is important as it is directly tied to the risk you take when you originate a loan. As renovation loans are our most popular loan type, I chose to highlight this report and help explain where you can go to further complete your due diligence before investing in a renovation loan for yourself. Next, what loans are owned by the mortgage fund today? This report is important for fund investors or prospective fund investors, as it allows them to review what opportunities are contained in the fund's portfolio for due diligence purposes. And finally, what is the default rate? Again, the default rate is important to understand as it details what our risk profile looks like historically for making these mortgage, trust deeds, and note investments. So now that I've explained each of the 5, let me navigate back to the marketplace and demonstrate how you can run these reports for yourself. So one more quick note before we dive in. You will need to have a website account and be logged in to fully take advantage of all the tools I'm going to show you in this next section of the webinar. So to begin, I'm going to go ahead and start with the report to find which loans are available now. To do that, I'm going to start by first clearing my filter. I want to go ahead and remove the old filters that I had run and make sure they don't interfere with my current report. Now, I'm going to go ahead and jump into the More filter section. And using the loan status filter here in the top center of your screen, I'm going to go ahead and use the option Deselect All, essentially removing all the loans from my report. Next, I'm going to select just the loan status of loans that are available and need funding. Clicking Done, I am now shown my report of loans that are available in List View. Now, I've said List View before in the presentation, so to dive in a little further to the concept, it allows you to browse multiple opportunities at a time and quickly get a snapshot of the details. You can personalize which fields, like loan status, and if you hover over the name, there is a little bit of a display case for you to understand what the terms mean, investment, yield, and so on. I can personalize which of these fields are displayed by clicking this yellow personalized display button to the right of your screen. You can also favorite or hide mortgages, so you're only looking at relevant content. And you can also find them later by clicking the favorite or hidden mortgage buttons to the right of your screen as well. Now, say I'm looking at this loan opportunity here in Sunwest City, Arizona, and it caught my eye. So to dive a little further without fully committing to looking at all the details, I can click it once and go into expanded list view and see a few more details about the investment before I proceed. But say you want to continue your due diligence, you're interested. So you can do that by clicking this full details button here, which will take you to a separate loan page where you can dive in deeper. Now, if you've never done this before, it's going to meet you with the following screen. This is the collapsed and condensed view. For information, it's divided into two sections. The first section is this loan information. The second is about the property information. If you want to look into a particular topic, say loan details, you can click once, and through the drop downs, be able to see the available information for you to continue your due diligence on the website. Now, we feel that we provided all the pertinent information for our investors to make a funding decision. So if that decision of yours is to move forward with an investment, you can commit to funding the loan on this loan listing. You can do that by scrolling down on your screen and finding this green Fund a Loan button. Now, as mentioned, you do need to be logged in and have a website account to create and utilize all the tools available on the marketplace. That said, though, the information we ask for is not invasive. It's just enough for us to continue to contact you and assist you in the funding process. To show you what that next step looks like, I'm now going to go ahead and log in quickly so you can see what that next screen looks like when you actually click the Fund This Loan process. So as you notice, the website will automatically populate your contact information. Then after you add your investing entity or select one that was originally there, you then can scroll down and click this blue Begin Funding Process. Afterwards, you assign a quick disclaimer W-9 form to formalize your commitment. Now, if you're not quite sure, you need a little more information, you can get that by contacting the analyst directly. You can do that right here. You'll see that my contact information, as I am the assigned investment analyst, is readily displayed for you. Or you can back out, scroll down on your screen, and just below that green Fund This Loan button, there is a Request Information button. Now, when reviewing the marketplace, please understand these investments are very competitive. So knowing your analyst team, like myself and my other coworkers here, is very important to help you stay invested. Also, when looking at information, it is also good to be decisive, as it helps you ensure that you're acting on a commitment before another lender potentially commits to fund that loan before you. Now I'm going to go ahead and refresh my screen because I do need now to log out so you can have a public view of the marketplace. Great. So changing from what our direct lenders see when they're trying to find what loans are available, I now want to show a few examples of how you as a lender can conduct your due diligence using the marketplace. I'll do this by demonstrating how to review both our current and historical pipeline, as well as how to review our mortgage funds activity and calculate the default rate in real time. To start, I will show what loans are active in our pipeline right now. Again, always be sure to clear your filters when you start. Dive into more filters. And then I'm going to use the loan status filter again, deselect all, and select all of the loan statuses that are under the bucket active. Then I'll click done. These are the loans that have dollars out with our borrowers, earning interest. Currently, we have roughly $100 million out in markets across the country. It's truly a humbling number and one that makes me grateful to our clients for your continued trust as we build and grow. But rest assured, we're very hands-on. So although there are hundreds of loans out, we are constantly checking and managing the pipeline as a part of our operations. For example, which loans are coming due? Are there any taxes or insurance issues with our pipeline? Have any of the renovation draws been released in a reasonable time frame? These are all questions that we ask ourselves on a regular basis and track in our pipeline to help mitigate risk both for our fund and our direct lenders alike. So same as before, the report starts you out in list view. And if you wanted to dive in further, you would just have to click on the full details button to go into that particular loan listing. Okay, 2 reports down, 3 to go. The next 2 reports are a bit more straightforward, and we will run through those quickly. For the next report, we're going to show our renovation loans on the marketplace. Now, this requires layering 2 search filters. This is a tremendous skill to be used, so be sure to pay attention. So first, I'm going to start by clearing my filters because I always want to make sure that I don't have any old filters that are going to hinder and interfere with my results on this new report. Then I'm going to jump into more filters, scroll over to loan purpose, deselect all, and then just select those that are in the renovate loan status. Now, the 2,000 results that I have here, those are in all different types of loan status, either active, need funding, or completed. I want to look at just those that are active. So I'm going to go ahead and go to my loan status filter, deselect all, scroll down, and just select those loan statuses that are currently active. Now, after going through this process and clicking done, I am now looking at all the loans that are currently out with borrowers and which have a loan purpose of renovation. Now, this report will help you to review other loans on the website and in preparation for potentially funding one of your own. You can review for yourself by going into that full details section, and you can find the loan details, loan terms, scheduled release of funds, loan to values, etc., to help with your decision and to better understand how we structure these renovation loans. Now, the next filter I'm going to show you is how to find loans owned by the fund. As we discussed earlier, this presentation is specifically geared towards our mortgage marketplace and the direct lender. However, I did mention that there are 2 investing options, direct lending and the fund model. The mortgage marketplace has the ability to sort between these 2 options so you can differentiate between which investments are held by lenders like yourself and which assets are held by the fund. As always, start by clearing your filters, jumping into more filters, and then scrolling down to the mortgage owner filter. From there, I'm going to deselect the individual investor. And next, again, same as before, I just want to look at those loans that are currently active. So I'm going to go to my loan status filter, deselect all, scroll down, and just select those that are in the loan statuses under the active bucket. I'm going to go ahead and click done. So this is a benefit for those fund investors to review the fund's holdings in real time. It's also good for the direct lenders as it allows you to review what types of loans are held by the fund. But say I want to go a bit further. For example, say I want to look at loans owned by the fund that are currently active, which I have on my screen now in list view, but also have the loan purpose of renovate. I can do that by not clicking clear this time because I want to keep my current report and just refine it further, diving into more filters, and making my way to the loan purpose filter. Here, I'm now going to deselect all loan purposes and just select the loan purpose, renovate. When I click done, I have now further refined my results. So now I'm looking at just those loans that are owned by the mortgage fund, that are currently active, and that have the loan purpose of renovate. So this concept of layering filters helps you produce very detailed reports and is tremendously valuable. So hopefully this will help you on the marketplace as you're sifting and creating reports for yourself. So finally, for our last navigational feature I will go over today, I'm going to circle back to help you calculate the default risk using our marketplace in real time. This helps our investors better understand their risk when making these investments historically. There are 2 numbers we need to calculate the default rate, a numerator and a denominator. To find that denominator, we need to locate all the loans that are completed, whether in default or otherwise. I can find those by clicking clear, jumping into more filters, and using the loan status filter, deselecting all, and then selecting those loan statuses that are in completed or completed in default.
Did it decline the tenant?
Now, it's important to note that loans which were completed in default does not mean that the lender had a loss of principal. For more information, recall the link to the loan status definition that I referenced earlier. You can go ahead, and if you're curious to learn more about these loan statuses, you can explore them after the webinar to find out exactly what they mean. Now, we are incredibly transparent, as we believe more lenders should be, and have no qualms about having our data available for lenders to view. This is an incredible resource, as it allows investors to see what our default rate is. And you can actually review details about the loans that did not go as expected, which is a huge benefit for note investors, in my opinion. So this report found our denominator, $22.99. We now can find our numerator by looking at just those loans which were completed in default. We can find that by clicking clear once again, going into more filters, using the loan status filter to deselect all, and this time just select those which were completed in default. Clicking done, I have 49 results on my report. This is my numerator. After dividing the numerator by the denominator, as you can see, we historically have roughly a 2% default rate over the past 12 years of lending, which is a fantastically low figure. While this is the general default rate, using the concepts I explained earlier, you can layer the loan status filter with the loan purpose filter to further dive into these numbers and to find out what percentage of that 2% default rate is allocated to renovate loans, hold loans, etc. So I want to take a moment and thank everyone who's made it with us this far. Hopefully you've learned a few valuable tools about how you can use the various search filters available to run reports that will help you as the investor leverage the marketplace to your advantage. As we continue the presentation, I now want to talk about why you should invest in these opportunities. I'm going to navigate off the website and pull up the PowerPoint once again to illustrate. So the first reason is passive, consistent income. We like to call these opportunities mailbox money because after you invest, simply collect the interest checks monthly from your mailbox. The income is more consistent and more passive than rental property, thanks to not having to go through vacancies or maintenance. Next, diversify from rental property. With rental property, depending on the overall economy and market conditions, you'll experience ups and downs with the investment. By putting some of your real estate allocation in debt notes, you will have a steady source of income that's less correlated to the overall economic conditions. Plus, since there's no mortgage payment or taxes, you enjoy a more pure cash flow experience. Third, the safety of first lien debt. We only lend in first lien position. This is much safer than lending in junior position or buying non-performing notes. So you enjoy greater principal protection and priority when it comes to payoff. Now, conservative LTVs is also a big selling point. We ensure to structure the loans in such a manner that keeps the borrower vested in the deal through completion. Not only does the borrower equity in the deal make it painful for them to walk away, but our conservative valuations helps protect you as the lender from overinflated numbers. Reoccurring experienced borrowers. We don't work with the weekend warriors or people who see an HGTV flipping show once and say, I can do that. Instead, we work with the folks on the HGTV flipping shows, professionals who are completing anywhere between 5 and 100 deals a year. These are the people you want to lend to, and we've built relationships with them as we strive to keep your money in capable hands. Finally, we take a hands-on approach. We're not like some lending establishments who help investors originate a loan and then disappear. Instead, just as we value our relationships with the borrowers, we also value our relationship with you, our lender clients. So we will be here to help. From origination through payoff, we are happy to offer our advice and resources along the way. Now, I know I covered a lot of information today, and it's really in a relatively short period of time. So if you need more information about anything covered in this presentation, please do not hesitate to reach out. I'd love to speak with you. Whether you are interested in direct lending or the mortgage fund, I would be happy to assist in answering your questions or helping you get started. My number and email are both on screen, or feel free to scan the QR code to schedule a consultation on our website. So once again, thank you all for spending time with us. Truly appreciate your attendance and hope you gained some useful insight into our mortgage marketplace to help you as an investor. It's been a pleasure speaking to you all. Now, for those of you who are still here, we want to wrap up with a few common questions from our investors and also go over some chats we received and questions through the chat prompt in the presentation. I'm going to go ahead and switch to our frequently asked questions screen to go ahead and start with those. First, a common question we get is, how does Marshall Reddick make money? This is a good question and it's completely fair. The answer is we get paid by borrower loan fees. If you've ever gotten a loan, you've probably seen the lender charge points and fees. Those are where the majority of our income comes from, and which allows us to continue servicing you, our clients. Now, that said, there are a couple small fees that are covered by our direct lenders. I'm going to show you quickly on the mortgage marketplace where those are located. Diving back into our mortgage marketplace, I'm going to quickly navigate back to what loans are available. I'm going to click clear, more filters, use the loan status filter, deselect all, and the loan status if available. Hopefully this is becoming second nature to you at this point. And now I'm going to go ahead and dive into this Arizona loan to demonstrate. First, on the right side of your screen, you'll see here that there is a $150 funding fee. That helped pay for the software costs of running the mortgage marketplace. Then there's a $200 release fee. That helps cover the cost of facilitating the lien release of the note post-closing. At the end of the day, our goal is to provide a great experience for our investors and to truly be a part of their journey to financial independence using these direct notes. The second frequently asked question I get is, how is my income from this investment taxed? Now, this is another good question. I'm not a CPA, but we believe these investments should be taxed as interest income. In our direct lending model, you collect interest directly from the borrower. Thus, the borrower is responsible for issuing you forms, such as the 1099 INT, at the end of each year. So if those tax forms are not received from the borrower, you must report the income as advised by your tax professional. Another question I get asked a lot is, what safeguards does Marshall Reddick implement to protect the direct lender? An easy answer is we always gain insurance, both title insurance to protect the lien position and dwelling insurance to protect the property, which is the underlying real asset on the loan. In addition, like we talked about earlier, we work with reputable borrowers at conservative lien positions. That does a lot to secure our lender's investment and contribute to our impressively low default rate historically. Another common question we get is, who is responsible for the note if there's a default? Now, as mentioned before, we avoid fractionalizing between multiple lenders in our direct model. It means if the investment is owned in your name, you collect 100% of the interest, but you also bear 100% of the responsibility up through completion, whatever that may be. Now, don't let that scare you because, again, we're here to help. We will be happy to provide resources to help you get through each stage of the process. Just like with every investment, though, there is an element of risk that is vital for you to understand when entering the private lending space. The fifth and last frequently asked question that we get often is, what is the Marshall Reddick Mortgage Fund? Now, we've been talking about the direct lending model mainly in the presentation, but we also have a crowdfunding option, like I mentioned as well. You can find out more about that investment option on our website. I'm going to go ahead and navigate there quickly just to show. From our homepage, you would hover over the Invest tab, and instead of clicking Mortgages to go to the marketplace, you would go one further down to look at our investment fund. Now, I'm not going to spend any time on this, but I just wanted to touch on it briefly before leaving for those who would be interested to explore further. So that covers our frequently asked questions. And we've also been fielding questions in the chat as we've been going throughout the presentation, and we'd like to address some of those now. Helping me with this webinar and presentation is Patrick Prunty, our Director of Private Lending, and he has been monitoring the chat, fielding questions, and he is now going to chime in and bring a couple to the forefront. So Patrick, great to have you here with us. What questions have the chat been posing?
Lots of good ones, Aaron, and thanks so much for the time and the valuable information. You did a fabulous job. First question we have coming in from the crowd revolves around the mortgage fund, and it's sort of twofold. The question is, are there any requirements to be able to invest in the mortgage fund? And the second part of that is, what is the minimum investment to get into the mortgage fund?
That is a great question. In terms of the first part of that question, what requirements are there? In order to invest in the mortgage fund, you do need to be an accredited investor. For those who are kind of unfamiliar with the term, there are two ways you qualify. The first is by income. If you earn $200,000 annually for the past 2 years, or if you earn $300,000 with your spouse for the past 2 years, with the expectation of making the same in this current calendar year, you would qualify as an accredited investor based on income. Now, the other way to do it is through net worth. If you take the sum of your assets minus liability and excluding any primary residence equity, if you have $1 million in assets outside of your primary residence, then you are also an accredited investor. So there's two different ways to do it. Oftentimes it's very simple as reaching out to your tax advisor, reaching out to your financial supporter and just asking them for a letter and confirmation, because they typically are more familiar with your investment and your current financial status and can quickly tell you if you qualify or not. So that'd be a great resource. The second part of that question is, as I mentioned before, you are subject to a minimum with the mortgage fund. That said, the minimum is a low threshold of just $25,000. It's really useful for investors who are using both options. We have some folks who like to invest in direct loans on the marketplace, but because you have to have 100% of the investment capital to make the loan, sometimes, say if you have $120,000 available, the loan amount may only be $100,000. What do you do with that extra 20? If you have an existing position, you can put that in the mortgage fund. Or if you want to put the $25,000 in the mortgage fund first and let that ride, you then can invest in direct lending opportunities on the side as you're going throughout the investment process. So that kind of covers a couple of those points there. That was a great question, Patrick. It's kind of like it's barrier to entry, right? You have to know, how can I qualify, and then what's the barrier to entry? Talk about the mortgage fund.
Yeah, fabulous. Good answers. Here's the next question is the overall Marshall Reddick private lending program. I think you've made it very clear that there's two options to invest. That's direct lending, that's one-on-one, that's the lender, the trustee investor choosing the loan and owning that loan directly. And then there's the mortgage fund, right? But overall, in terms of the private lending program amongst both of those investment options, how much is Marshall Reddick currently managing in terms of total dollars?
So in terms of total dollars, I think I referenced this back in the presentation a little earlier. We're managing roughly $100 million. I mean, that number does fluctuate. In terms of the split, it's 35 to 40% is mortgage fund dollars. And then about 60% would be in the direct lender capital. So as it has been since the beginning of our private lending program all the way up to today, the majority of our loan opportunities and the investment capital comes from our direct lenders like yourself.
Great. Yeah, thank you. Okay, a question revolving prepayment penalties. So maybe you could speak to that a little bit from both the borrower and the lender side, and specifically on the lender side, how is that a benefit to a direct lender?
Great. So yeah, on the borrower side, briefly, this webinar has been more focused on our direct lenders. But for the borrower, we typically phrase it as an interest guarantee. We tell the borrower, based on what loan purpose they want to use, because each one differs and varies. But based upon the loan purpose, we tell the borrower, in order for our lender to make the investment, there's going to be a minimum period or a minimum amount they earn for taking that risk and funding your loan. So they range from 0 for bridge programs to 3 months to 2 years. It really depends on the type of loan program that you're looking into. Now, that's a benefit to you as a lender, as say, for example, on a renovation loan, there's typically a 3-month interest guarantee on that loan. So essentially, you are owed as a lender at the time of funding a minimum of 3 months worth of interest. But say, for example, we've had this happen to our lenders and the mortgage fund several times. We have a borrower who bought the property at a great deal. And as I mentioned, we're working with professionals, people who know how to find a good deal in real estate. And say, as they're getting ready to start the renovations, maybe it's only been 30 days at this point, another professional reaches out to them and says, hey, I would like to buy that property from you for a significant premium than what you bought it for. Now, the borrower says, great, I just made $20,000 and I didn't have to do anything. So he agrees. Now, what that means for you as a lender is, since the loan is going to pay off within that 90-day period, you are going to receive the balance of that 90-day interest due. So in my example, say the offer was made 30 days in, and then say the property was officially sold and your loan paid off at day 45. In that scenario, because you're guaranteed 90 days worth of interest, you are going to get a lump sum of 45 days worth of interest just for making the loan. This is an amazing value and will really spike to increase your annual yield if you're able to deploy those dollars quickly into a new loan. Well, this scenario is not one I would say that's common. It does happen. And we, as the mortgage fund, have experienced it several times, and as have our other lenders in the program. So hopefully that helps kind of cover a little bit more about the interest guarantee, repayment penalties, and what benefit they are to our lenders as well.
Yeah, and we're just getting so many fabulous questions. We won't be able to get to all of them, but I've got a handful more.
Sure.
Question revolving around the administrative tasks in managing your loan. So I think that that's geared towards the loan servicer. So maybe you can speak a little bit to the lender's choice to hire or not hire a loan servicer.
Sure.
And if you choose to hire a loan servicer, what is that servicer's role?
Sure. Yeah. So I'll go ahead and kind of take a step back and do kind of a 10,000-foot view. You kind of have different stages in the loan life cycle, if you will. Your administrative tasks, or your kind of to-do list tasks on the front end before the loans originated, is you're going to need to be involved to help approve loan documents, to help confirm and approve insurance, and to help get the wire into escrow or title or whoever is helping close the transaction for the borrower. Now, we do most of the legwork, so it's a very simple, streamlined process. We want it to be easy for you as the investor. But once you're through that phase, then you're in the funded phase, or the phase where your dollars are actually out to the borrower, and the borrower is now, working on the project or doing whatever the loan purpose was for. During that period is when you start collecting monthly payments. Now, for our short-term loans, those are loans that have maturities of 12 months or less. Typically, what we do is we help connect our lenders directly with the borrower, and we say, hey, Mr. Borrower, here's our lender, and they are owed monthly payments beginning on X date in the amount of X. Please send them a check to this address, or if it works and the borrower has the capability, they don't all have the capability, but for those that do, and for the lenders that want to receive it that way, we also can say, please send the payment to the lender's bank account via ACH or some kind of electronic transfer. So during that process, the borrower is responsible for sending the payments directly to the lender. We do not service the loan opportunities. We're here to help. And if you are not receiving payments and you want to, reach out to us and help figure that out, we would be happy to jump in and help talk to the borrower and see what's going on. But that would be a little bit more involved, because you as the lender would have to administratively just keep checking to see that a payment shows up every month. If you don't want to do that and not worry about the accounting, not worry about the payments, you can hire a third-party loan servicer. Essentially, the loan servicer takes over that role. The borrower would get connected to the loan servicer, set up an account on their system, and make the payments directly to the loan servicer. The servicer would worry about all the accounting, all the collections, and all the payoff figures, and be able to send you just the check each month after they receive the collected interest from the borrower.
Yeah, great answer, and really suffice it to say there that the loan servicer is sort of like a property manager for your loan.
Absolutely.
That's always an option for you as the direct lender to hire that loan servicer. We certainly have relationships with multiple loan servicers, but at the end of the day, you're welcome to loan service with loan servicer of your choice if you already have an existing relationship. So the choice of loan servicer is yours, or you don't have to loan service.
Mm-hmm.
So fabulous.
Well, one note before we move on to the next question, I do want to mention for those of you who are looking for those real mailbox money opportunities, we do require loan servicing on our longer term loan products, just because if that loan's going to be out for 2, 3, 5 years, that's 60 payments potentially that you'd have to keep track of. And, you know, we all know life is busy and these are made and posed as passive opportunities. So thankfully, a lot of times that's borrower paid expense. So it's a huge benefit to you as a lender just to get that added in and collected as a part of your loan.
Fabulous. I have a question here, and the question revolves around loan fees paid by the borrower. And that not really being the question, but the question revolves around, like, maybe you can describe the two models that we have. That's direct lending, that's the mortgage fund. On the direct lending side, who earns what? Like, what does Marshall Reddick earn and what does the direct lender earn? And then go to the mortgage fund and say, how does the mortgage fund differ in that capacity?
Sure. So that's a great question. As I mentioned earlier in like our frequently asked question, you can see it as number 1 on the screen currently. How does Marshall Reddick make money? In the direct lender side, you select the investment you wish to fund. We prepare loan documents, title and property insurance, give you wire instructions to escrow. And then once you wire in your funds, your dollars start earning interest on a daily, monthly rate. And so we, as Marshall Reddick, the broker, the service provider, managing the Marshall Reddick mortgage place, we are not taking any of the interest. You own 100% and you collect 100% of that interest. We get paid and we get compensated by the borrower paid loan fees. We charge a standard loan fee with minimums and in addition some like document preparation fees and other small fees to the borrower, and that is our income. The direct lender earns 100% of the interest, including any interest guarantee if the borrower pays off early, and then we earn the fees at origination to help broker and facilitate and do the legwork on the loan opportunities for you as the investors.
Would it be safe to say then in the direct lending model that Marshall Reddick earns the points and
Yes.
the lender whose money is in the loan earns the interest?
That's absolutely correct.
And
And
how does that differ then with the mortgage fund?
it differs slightly. So this is how it works in the mortgage fund. On the direct lender side, Marshall Reddick earns the points, as Patrick said, and the direct lender earns the interest. With the mortgage fund earns the interest and the points. When you join the mortgage fund, you would have a capital account. Say $25,000 is your capital account. Your capital account represents a percentage of the total mortgage fund. So what happens in the mortgage fund is the mortgage fund collects all the loan points, all the interest guarantee if a loan pays off early, all the monthly payments from interest. And at the end of each quarter, we waterfall the entirety of that dollar amount to the investors. So you get an opportunity to participate in the profit of not just the interest, but also the points.
Fabulous. That's a good answer to the question there. Thank you very much. And I think you answered the final question that we're going to take tonight, but I'll just reiterate that. Payment or income stream between the two options that we offer the investor, right? Again, that's direct lending versus the mortgage fund. So in the direct lending, the payment frequency is?
It's monthly. So every month you will have a check due.
Okay, and on the mortgage fund side, the payment
It's quarterly.
frequency?
So essentially on the direct lending side, every month, just as for those of you who have a mortgage of your own, you pay that monthly. It's due by a certain date, and within that time period you have grace, you make your payment, the lender collects it, it's due the next month. In the mortgage fund model, we give quarterly distributions. Now, what's unique about the mortgage fund model is you have a bit more flexibility. At the end of your quarter, after we do all the bookkeeping and we tabulate the numbers and waterfall down the profits to all the investors, you have the opportunity to either take the distribution in cash, ACH, like check, that's yours. And also, I also want to clarify too, in terms of cash, I meant cash in the form of check or ACH. We're not a banking institution where you walk in and we have like an ATM machine on standby. You want your, thousands of dollars for the distribution in cash. We're happy to accept contributions to the mortgage fund in that way, but we can't distribute that into the actual fund. But on the flip side though, you have also the opportunity to reinvest your earnings. This is a real benefit of the fund because with the direct lending model, if I'm receiving my interest payments monthly, I can't add those to the principal balance of my note to have them start earning as well at the same rate my note is earning. But on the mortgage fund side, I can add my distribution to my capital account. And then for next quarter, I'm earning not just on my original capital account, but also upon my last quarter's distribution. So you get to enjoy the effects of compounding in that model.
Yeah, fabulous. Yeah. So just to recap there, tons of information. In the direct lending model, when you own the note, you will be collecting a monthly stream of income. That'll be that mortgage payment that you collect. And on the mortgage fund side of things, the mortgage fund is collecting the same monthly mortgage payments. We just only once per quarter aggregate all the income minus all the expenses to get to net profit, and then distribute 100% of net profit to all capital partners based on their percentage of ownership.
That's exactly right. All right. Well, thank you all so much. And again, as Patrick mentioned, there's been a ton of information on this webinar, and it's really just been a relatively short amount of time. So if you have any follow-up questions, please don't hesitate. You're more than welcome to reach out to me. My number and email are on screen, or you can use the QR code to schedule a consultation on our website. So thank you all once again. Hope you all have a great night. I look forward to catching you next time.